In this video, I'm going to show you an options trade setup that we had in Marathon Petroleum. Ticker MPC resulted in a 58% gain in 8 days, just using simple support and resistance and looking at a consolidation area. I'm Scott Bauer, and I'm here to help make you a better options trader. Hey there, everybody. Thanks so much for joining me. We're going to discuss what we did here in Marathon Petroleum, MPC, and this has been a great trader for about the last 4 or 5 months or so as the overall market has consolidated. And as you can see here, this stock has consolidated. Now, what am I talking about? First, let's take a look at this chart up here, okay? And this is a 1-year chart. But going back 1 year, look at the incredible support, okay, over the last year at the 200-day moving average, which is this blue line, and then most recently here, 1, 2, 3, 4, basically 5 times on the 50-day moving average. Okay, so this is over 1 year, and that support there has been incredible. Now, let's take a little bit tighter of a look, and let's look what's happened over the last 3 months or so in this massive consolidation. Okay, check this out. I mean, this is a pattern that is just played out unbelievably. I mean, such a defined upper bound, lower bound here. And we've taken advantage of this a few times. So the last one that we did here was just a couple weeks ago on April 4th. So on April 4th, okay, MPC went all the way from pretty much the top end of this range right here, right to the bottom end of the range, which also correlates to the 50-day moving average. So we jumped on a trade right here when this thing came right down to the 50-day moving average. And what we did was we bought what's called a broken wing call butterfly. Now, some of these, some of the terminology about different option spreads sound like they may be really convoluted or really complex. It's really not. What a butterfly spread is, and you can do a call butterfly or a put butterfly, but we did a call butterfly here because we were bullish, was a combination of just 2 simple vertical spreads. So what we did here on April 4th is we bought the April 28th expiration 138 call spread. Okay, and the reason that we did that, is because when the stock came down to hit that 50-day moving average right around 126 here, we measured out what the expected move, what price the option market was pricing in for Marathon going out to April 28th. And at that point, it was about $12. Okay, so what that means is the option market was pricing in a move plus or minus $12 in MPC going out to April 28th. And since we were bullish, we were targeting 138. So what we did was we bought the 138 call spread, and at the same time, okay, we sold the 140 call spread. We did this part, the sale here, to help pay for what we bought, to help pay for the long part of the spread. So in any butterfly, any regular butterfly here, you're always going to have a 1 to 2 to 1 ratio in the options that you use. And that's exactly what we had here. Buying one of the 130 calls, selling 2 of the 138s, and then buying 1 of the 140s. This gave us a nice opportunity for an upward move. Okay, so here was April 4th. On April 11th, 1 week later, we got a move in MPC from basically right here at 125 half-ish right to here, which was over 133. $8 move in MPC in literally 1 week. So our spread that we had paid, what did we pay here? We paid $2. Paid $2 for that spread initially. When the stock went up to 133, we sold that. We sold half of our spread for $3.50. Okay, the reason we sold half was we want to take partial profits. We want to take some money off the table, but still look for a continuation to the upside of following that trend. So if you look at this here, we made $1.50 on a $2 spread. Okay, $1.50, $2 spread. That's a 75% profit in 7 days on half of our position. Okay, now something we also do here is we will use stop exits to protect ourselves. So even though we were looking for MPC to continue that trend to the upside here, you can see that never happened. It didn't hit that peak again. So what we did was we put in an order to protect ourselves in case the stock came back down. And sure enough here, we got hit. We got what's called stopped out the following day on April 12th. We got stopped out at a price of $2.80 on the balance. Okay, so even on the remainder of the position, remember, we bought this for $2. We got stopped out at $2.80 on the balance. So for 50% of the position, we made 40%. The first 50% of the position, we made 75%. Okay, so the total amount of time in on April 4th, out on April 12th, 8 days. We made a cumulative 57% on this position, all by following the trend of this range and also respecting all of this support over the last year that we saw at the 50-day moving average. So that's what we look to do on a daily basis here. And we look to identify these trends. We look to identify possibilities. Look at, okay, what is the best opportunity? Where's the best reward to risk? And we go from there. So thank you so much for joining me, everybody. I wanted to show you this one especially because A, we only had this thing for 8 days, and B, not only did we make some really decent profits, but we locked them in by using a stop, which triggered also, which is just tremendous for risk management. Thank you, everybody. Really appreciate you being here, and we will see you on the next one.